now we'll turn to Asia, and we want to talk about what's happening, not just China, but also some of the broader areas where there is growth, and it's a matter of where is the growth and how is that going to impact the U.S., how things are moving, and just supply chains in general going into Europe, as we just finished talking about Germany. So just remember, just to highlight again, I mistakenly said one option was equal to 10 shares. It should have been one option is equal to 100 shares. I just was so focused on trying to simplify the Greeks, and I misspoke, so I apologize. So now when we just want to look at Taiwan and what are some of the shifts in the Taiwanese economy, because Taiwan is a big component of, obviously, the supply chain for technology, especially when you think about the U.S. and how Japan has come out and said or come up with plans to protect Taiwan in terms of a Chinese invasion, what the U.S. would do. And it's just we want to look at what are some of the CPI sides. So you can see the CPI core has fell a bit, went from 1.4% to 1.36%. CPI year over year, same thing. WPI, a little bit higher. But when we look at the unemployment rate, we actually had a big increase in unemployment, and from 3.72% to 4.15%. Now, this is a mixture of some of the slowdowns that we've talked about, where there's issues with power, there's issue with water, and this has pulled some of that out in terms of just slowing some of those supply chains in general. Now, the trade balance in general is also an important one to look at in terms of where that strength is going to continue. And when you look at exports came in above estimates. It was expected at 33%, came in at 35.1%. But imports were expected at 34.5%, came in at 42.3%. So typically when you have imports like this for a country that is a net exporting nation, they're importing goods to then turn it into a finished product, semi-finished product, and then export it. So this actually speaks well for where exports will be going on the go forward. Now, they do have some issues with COVID as the other areas, but so far things have been maintained, and we should see some pretty steady growth coming out of Taiwan at this point in time. Now, India, on the other hand, is a very different story. And when you look at where some of the manufacturing PMI is, it's now back in contractionary level. It came in at 48.1. When you look at services, came in at 41.2. And then on the composite or the aggregate, came in at 43.1. So not surprising, given the fact that they had COVID, there was lockdowns, the consumer was struggling. But now when we look on the other side, we see some of that manufacturing coming back, but not as much on the service sector, because we're still seeing some of those headwinds as the consumer has struggled. There's still some concern about, well, how much is the Delta variant still around? What does this Lambda look like? Because we're starting to see some of that spread in that region as well. And this is, again, putting a pause on the recovery. And that's where when we look at China, which was the first one in, first one out, we're still not seeing them get back to normal. And I think that's missed on the market in general, because when you look at where their recovery looks like, where their recovery sits right now, that's where some of that struggle sits. And India, I don't see it being much different. And even though some things will get back to normal, there'll be some of that residual pressure that will just weigh on what that recovery really looks like on the aggregate. And you're seeing it throughout the ASEAN. So when you look at the ASEAN in general, on looking at the aggregate side, we're actually in manufacturing is in contracting. So it's below 50. So it's the fastest fall in output since July 2020. Renewed declines in new orders, business confidence dips to 10-month low. There's a lot behind that. And it's important to think about what is behind that. It's COVID, but there's also the supply chain. The supply chain remains constrained. There's a lot of issues in what the supply chain can handle. Rates have exploded, and there was such a backlog in orders. I don't need new orders yet. I just need to get the orders that I've already put out. And hopefully and at the same time, prices have exploded. So why am I going to lock myself into new orders at a higher price when you haven't even filled, or I still have my back orders? So this is also going to put some pressure on the ASEAN. And as we talked about in segment 1, emerging markets are already starting to see rate hikes, inflationary pressures, which again are becoming a bigger issue as we look at what is the go forward on this global economic recovery and that underlying demand. So then when we turn to China, because China also saw a fairly big miss, and first we're going to talk about manufacturing PMI output. So you can see it's coming much closer, and it's still growth, but it's within a margin of error, coming in at about 50.9, because typically when you're between 48 and 52, there's some expansion, but minimal. And as you get closer and closer to that 50 mark, you're essentially just holding firm. You're not really seeing much growth. You're not seeing much decline. You're just kind of holding in this pattern. And this is the pressure that we're seeing, because there's pressure on the outside in terms of imports, exports, but there's also pressure internally, because the consumer continues to be fleeting without really any support for the local economy. And that's why when we look at the composite, so when we look at the composite for China, and I'm just going to pull up what their estimates were just to compare apples to apples. So when we look at the PMI composite, so the PMI composite came in at 50.6. Previous was 53.8. So again, you're seeing just how slow that has gotten. And then when we look at services was expected to be at 54.9, came in at 50.3. So a big miss. And when you look at services, that again is speaking back to the consumer and what some of those pressures are. Now, we're going to talk about the RRR rate and what China is looking to do to provide some stimulus, but they're trying to do it on a very targeted level, where they want to target the stimulus in general to try to mitigate. They don't want to give the large caps and some of the state owns. They're trying to provide support for the mid cap, that small, medium cap, and the micro cap, because right now the provinces are the ones trying to provide that support. And when you look at where that exposure is, they don't have the capacity to do that. And I think it's important to go through where that exposure resides as the economy comes into a kind of this slowing pattern that we've been talking about, and now is finally coming out in the official data. So when you look at growth in China's bond market, the local government side is the one that we want to talk about, because we know the non-financial corporate bonds have been an issue, financial bonds as well. The biggest one that we want to talk about going forward is the local government bonds, because that's where we're seeing some of these pressures, because they have provided lending to a lot of the state-owned entities that are now either at risk of going bankrupt, have gone bankrupt, or have maturities coming through, which is why there's starting to be a little bit of a need to provide support for the mid cap, micro cap, because the consumer isn't really buying. And that is impacting small businesses way more than large businesses, which again is creating some of this underlying problem. So then when we look at the outstanding debt securities, it's important to understand where those securities sit, because when you look at when you look at the U.S., obviously there's a lot of that sovereign, but the local side of the U.S. is not a huge component to it. But when you look at China, the local government side is a big piece of it. And when you look at the quasi-sovereign, you can see just the sheer size of that percentage of total and why this is becoming a bigger problem for China to address. So even though the PBOC is trying to do something to provide support, they also have a debt problem, which they're trying to avoid. So it's less about credit impulses going up. It's just that they're going to stop going down, and they're going to try to get more targeted in the way they can provide support to the quasi-sovereign and the local governments. And this is just looking at, in a different way, the growth over time of the local government. Because remember, back in 2015, 2016, they were given a directive to lend. They were given a directive to infrastructure projects, support build out the area, try to do something to drive growth. And now they did it exponentially with very little oversight, or not the oversight necessary, which became a very big problem, because they invested blindly, and they invested in SOEs that they assumed were state-owned. There were going to be a certain amount of safety, and that's a block that is very concerning, and you can just see the growth over time, which is why the PBOC is so focused on this, which is why we talk about the LGSVs. What does this mean going forward? Which is just the local government sovereign vehicles. And these are some of those components that I don't think is appreciated when you're looking at China and some of the nuances within their debt problems. So now let's look at the change in capital ratios, because this is going to be important going forward when we look at how are the changes impacting. Because right now, the Tier 1 capital, that is where you see some of this negative moves in terms of the percentages. But the other Tier 1 capital and Tier 2, that's the one that they're starting to look at. Because when you look at capital growth at large banks, it's been fairly stable, but small banks remain under pressure. So how do you get this money or this capital ratio into some of these smaller banks? Because that's where they're seeing some of this risk, and that's where you've seen some of these perpetual bonds that you can convert into PBOC bonds and trying to inject cash, but doing it at a smaller level to try to avoid some of the issues that we've seen in general. And if you remember back in the end of 2020, beginning of 2021, we had said credit impulses are shrinking. Credit impulses are coming under pressure. It's going to happen until the PBOC blinks. And every time China tries to tighten things up, they blink and panic. And you can blink and panic if you still have spare capacity when you look at debt to GDP ratios, when you look at trying to get to growth over time. But they've invested poorly for so long that they don't have the ability to panic and blink. They have to be more strategic. And I think it's a very interesting way in how they're trying to roll this out and focusing on that small bank side, micro, mid-cap company side, trying to help them out and let the others deal with some of those issues. But by doing that, it's actually being reflected in the bond market, and you're seeing bonds come under pressure at the large cap and the state-owned side, because not only did you have Yuan go south, but now you have the support being called into question, because you're like, all right, well, it's a state-owned enterprise, but yet you're not going to stand behind it. Instead, you're shifting gears. And these are some of those nuances that I think are important within the debt structure. So now let's look at Chinese banks total and risk weighted. So when you look at risk-weighted assets, this is the other side of the equation, because small banks have more and more of this risk. They're smaller, they're more regional, they're more provincial. And when you look at how they've invested and how they've essentially been doing a lot of lending under the direction of some of the local sovereignties, the local provincial governments, they've been steered incorrectly, or they've been steered to lend into areas, which is why you're seeing a lot of these provincial governments that are essentially taking tax revenue and just dumping it straight into interest expense, because there's such a shortfall and some of these concerns, which is why local government bond issuance for supporting small banks is increasing, because they're trying to support, because again, the local government bonds are trying to support their small banks, because they just need these banks to survive because of the knock-on effect that would be created if they failed, which again is why the PBOC is trying to create what they're structuring. So now if we look at capital expenditures, here's where we can see Q1 into Q2, things continue to slow, because again, as we've seen over time, and so far Q3 is not looking any different. You're actually seeing some of these investments decline, especially when you start looking at the real estate and in the manufacturing side, because they're trying to build up some of those services, especially agriculture. Even though agriculture's come south, retail has been a big focus, and they're just not getting some of those CapEx increases. But and this comes down to some of the, tying it all together, looking at small, medium, the micro enterprise, that's mid cap, is seeing the decline on capex while the large cap is growing. So again, they're trying to support the smaller companies because that's where they keep seeing the pressure. That's where the job losses are coming from. That's where the wage compression is coming in. And this is where some of those overhangs in the underlying economy are residing, is in that small company. So then when you look at copper versus Chinese business surveys, copper, has continued to rise, but the survey, and not to say that copper is going to continue to go up, it's just not going to come down. There's not a huge supply response, and there's still that demand based on whether you're ESG or some other structure, which is why there's going to continue to be that pressure on PMI, just because of that cost. The cost is so onerous when you look at commodities, which is why China has focused so much on trying to adjust their commodity price, putting in the floor in by saying, look, we're going to sell from national storage at 3 to 7% below going rate, try to bring some of that pressure down, try to mitigate, because it's not just the export market that's going to get hurt, but the local consumer, because right now CPI has been depressed, PPI has exploded, it has not converted into an increase in consumer pricing, and that's something that the government is trying to avoid, especially in obviously the 100th year of the CCP. So when you look at Russia, because I think this is important when you're considering where the renminbi is, where the US dollar falls, and this is just an example of how the US dollar has fallen out of favor within Russia, and why some of that pressure remains within the Russian entity as their exchange rate falls under pressure, because do you trust the renminbi or the dollar, which is why we continue to see gold become a much bigger holding, as well as the euro within Russia, as they try to diversify away from the dollar, trying to get away from it. But and you can only do that to a point. But this, again, is something that Russia has done and other countries have started to do in different ways, which is why we have to look at how much of those holdings are in the US dollars. Now, the US dollar is still the reserve currency of the world, but it is actually at the lowest it's been since, I believe it's the late 70s, early 80s, and it's actually fallen to just below 70% of global holdings, closer to 68%. Where when you look at it, where it was historically, it was at 85, 87%. So again, some of those pressures that remain, nothing happens in a straight line. This is something that's happened over the last decade or so, but just something to watch as countries may try to diversify further. So now that when we talk about that, because China has tried to get away from the dollar, and they've, not to say that they've abandoned that, but they've purchased some excess dollars, some excess treasuries. Because when you look at monthly maturities for Chinese firms, there is a problem. And you can see how 2021 is ugly, and then you could see it still remains into 2022 as China has to roll debt, whether that's on a corporate side, that's on a sovereign side, that's on a local provincial side. And the only way to try to secure against bad debt expense is to try to purchase more dollars and increase your foreign reserve holdings to have more collateral. So if something does go wrong, you don't have something similar that happened with Iran, which is why they're going aggressive to figure out how much off balance sheet risk is there, where is the risk in general, and how do they find means of adjusting that and protecting against a potential problem. So this is where we want to look at the reserve, the reserve ratio, and when you look at the required deposit reserve ratio for major banks, smaller banks, and then rural commercial banks, it's always going to be the lowest at the rural side, because this is just showing what do you have to have on your sheets to secure yourself, and they've been trying for, as you can see, since 2019, to incentivize investment away from the urban and the suburban setting. And they're trying to do that with the rural commercial banks. Now, when you look at the smaller banks in general, again, they're trying to give some leniency, but this is where we'll see some sort of an adjustment. And it'll be done at the smaller and the rural commercial bank, because that's where they're going to try to support and provide some benefit. So when you look at the difference this time in that Chinese policymakers are way more concerned about small businesses being squeezed by rising raw material prices, wage increases, inflationary pressures, lack of consumer demand. That's where we're seeing some of those pressure points. So the recent data, including the CAIXIN, service PMI, also showed broader deceleration in the economy. Bloomberg's GDP proxy fell below 8% in May. I still think it's even lower than that. So a triple R cut is likely, even if it's not guaranteed. And that's why it's important. It's something that is going to be considered. And this is an easy way to do it. I'm not saying it's going to happen, but there was a good article out of Bloomberg that actually highlighted this as an option, which is a fair way to try to prop up some investment, but have it be very targeted, because you can adjust those very specifically. So when you look at the emphasis on supporting smaller businesses points to a targeted triple R cut rather than a blanket move for all banks. Thirdly, a triple R cut may not add net liquidities. That's the key component, because when you think about credit impulses, you can inject money into one and either pull it out on a different level or at least try to minimize the growth, which is what we're seeing. So that's some of those key pieces that are starting to roll out, where you can see some of the adjustments, which is why the credit impulses could just stop going down, not so much increase. And I think that's the deviation that I wanted to highlight when you're looking at this specific chart. You can target one, and it's a smaller bank, or on the rural side, but you're going to not do anything on the major bank side. So then that you'll help adjust that, or you could even increase one a little bit and decrease the other two. And that's some of the optionality that is available when you look at some of those specifics. You can see since 2013, they've gotten more creative with how they're trying to stimulate, which is why I've talked so much about why they want to invest in farmland, why they want to invest in rural, driving the consumer. And that's where they've tried to give more preferential treatment to smaller banks and the rural banks. And thirdly, a triple R cut may not add net liquidity. There are large amounts from the medium-term lending facility maturing, totaling 1.1 trillion yuan in the next 2 months. So all you do is just don't renew. And we've seen that, and I've retweeted it, and I've tried to highlight, there are some points where 30 billion expires and they only reissue 10. So they technically took 20 billion out of the market. So that's another way to manage that liquidity side. So, and with 1.1 trillion yuan in the next 2 months, you could easily cut the triple R, but also take some of that money out, offsetting some of those increases, keeping things, again, just stopping the credit impulses from going down, but really not keeping them from going up. The PBOC could refrain from rolling over these loans. A potential triple R cut is then designed to offset the liquidity drain from the maturing MLF or medium-term lending facility. And this is just looking at some of those ceilings. So the new ceilings will not force banks to reduce deposit rates. So it's good because you won't see the ceiling adjust. So the rate ceiling for the big four banks, actual rates for the big four banks. So you're not going to see those movements because it won't force them to reduce deposits. So they can still keep those deposits, moving some of those rate ceilings up. And then when you look at the rate reform lowers the allowed rates on long-term deposits. So it's one thing where you're going to incentivize a bit more of a shorter term. So you're going to incentivize a bit more of a movement in investment, because when you look at the long-term deposits, the previous ceiling and then the new ceiling, you're going to pull some of that forward. So the idea is incentivize investment, take some of that pressure instead of just leaving it in the bank, get it back into the market, a way to try to drive stimulus, or try to drive economic growth without mandating it. And these are some of those issues that we're going to have to look, because it's not just the triple R side, it's also the long-term deposit rates and how they can try to incentivize and move some of those investments through. So that's all we have for today. I know that there was a lot on some of the structural differences within China, but again, there's a lot of slowdown. There's a lot of there are problems that continue to grow within the region, and they're trying to find ways to address it, but without a real pickup in exports, without a real pickup in the consumer, it's going to be difficult to see a healthy recovery or a healthy move higher. So if you have any questions, again, please let us know. We love the back and forth. You can find me on Twitter or in the comments section. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.